You are listening to Mining Stock Education, where you'll learn from the top leaders in the natural resource sector and uncover quality mining investment opportunities.
And they can last a lot longer than you expect, these periods, but they do only come around, like this level of disdain only comes around once, maybe twice a decade if you're lucky. So if you've got the stomach for the volatility, this is what you've been waiting for, right?
Welcome back to Mining Stock Education. I'm your host, Bill Powers, chatting today with Sam Broom. He is a portfolio manager and investment executive with Sprott Global, originally from New Zealand, and he also has a geological background. It's been a while since Sam's been on the show, but Sam, always appreciate your insights. Thanks for joining me today.
Cheers. Thanks for having me, Bill. It's definitely been too long.
Yes. Well, you talk to investors on a day-by-day basis. I know that the life of a broker, especially during more emotionally charged times when portfolios are going down and not up, you take more calls. Can you share with us a little bit about the sentiment that you're getting from your clients and how are you counseling them?
Yeah, sure. I mean, look, if lost hours sleep is a good sentiment read on where we're at, this is definitely the worst we've seen it in my career. I've been in this, I worked as a geologist or engineering geologist in the mining sector prior to moving to the financial markets when I joined Sprott. That was about early 2016. So I've been in the gig now for 6 or 7 years. And I can honestly say this year's has been the toughest for me personally, unless you're a complete psychopath, you can't help but feel the moves when they're, of the magnitude as they've been, particularly the last sort of 6 months as the Fed has really tightened liquidity globally. I mean, it doesn't really matter what asset class you've been in, perhaps with the exception of the US dollar. And even then you've got head inflation, hitting your purchasing power. It's just been a tough year to be in financial markets. So from my point of view, yes, Sentiment's probably the lowest I've seen in my career, particularly in the precious metals space, which is now going on 2 years of a correction. You probably have to say it's turned into at least a micro bear market, this year. There are a few sectors of the commodity space that have held up better than most, particularly energy. But absent that, it doesn't really matter where you've been the last 6 months at least, and in the precious metal space the last 2 years where you haven't taken it on the chin. So, my job here at Sprott is to, put the emotions aside and make the best investment decisions you possibly can. And, looking on the flip side, there are now some of the best opportunities I've seen in my career too, or at least in the last 4 or 5 years. Since 2018, things got pretty low as well. I remember feeling it 2018 when everyone started calling for gold to drop below $1,100 again. Similar kind of conditions, the Fed raising rates before they did that about face, rapid pivot of the pivot. So there are similarities to back in 2018, but if you've got your wits about you, you've got to look at the upside, and there is a lot of opportunity out there at the moment.
You mentioned we have to put our emotions aside. Are there any charts or what concrete data are you pointing your clients to talk about the opportunity you see now? You can just look at something simple like valuations, right? There are times where quality gold miners, let's say, were trading well above 2 times P to NAV multiples, 2.5 times P to NAV multiples. Those same companies today are trading often below 1 times NAV, which there are companies that I haven't seen trade below 1.5 times NAV, right? And here we are, sub 1 times NAV, So obviously those NAVs move around depending on what commodity prices you get, cost inputs. So it's not a static metric that you can, rely on to say that they're not going to go any lower. Costs can always go up, commodity prices can always go down. Some people will say the mining equities are pricing in, margin compression in the future, which may well end up being the case. But generally speaking, in my experience, these multiples are like sentiment indicators. And when they get really, really low, it's usually a good time to buy. And when the reverse happens, it's often a good time to take some profits. So,
it's not always as simple as that. There are some nuances. A lot of times at the very peak of cycles, mining company multiples actually look the lowest because they're making the most money because the margins have expanded. But perhaps something like the lithium space at the moment could be a good example where margins are extreme to the upside, and I'm a little bit cautious, but we can chat on that later on. But in general, valuations are very cheap. If you look at sort of more technical positioning type data, just go and have a look at something simple like the commitment of traders reports, which is real money, right? That is real market participants and how they are positioned. You've got in the gold space, you've got commercials near record, unshort. You know what I mean? They're usually always by their very nature short, but they're long the actual commodity, right? So they view the current pricing situation as being, a low gold price, and then you look at the reverse of that, which is the managed money. The more speculative money are net short right now. There's only been a handful of times in the last 15 years where that's been the case. So there is quite a contrarian setup out there. I'm talking particularly about the gold space here. We're a broad commodity focused firm, but we do have a gold. Gold is in our DNA. Eric Sprott, who we're named after, is obviously a pretty big name in the gold space. So, that's where I look first and foremost. But you can apply that same positioning standpoint to just about any of the commodities. Copper, for example, has a very contrarian, bullish positioning setup right now as well. So,
do you think economic weakness is a threat to copper, though, over the next 12 months?
That's the consensus view, right? There are two ways of looking at copper here, right? You look at visible inventory levels globally in warehouses, the LME, Shanghai, they're very, very low. Then this is not what you usually see when you've just taken a 30% bath on the copper price. It's not like we're awash in copper, at least in terms of visible supplies. You then look at the projected supply-demand balance, particularly out sort of late next year into 2024, and it starts looking pretty dire. If demand even stays flat or even slightly declines, we're staring down the barrel of some pretty sizable deficits. It catches my attention. When I look at the stuff, I'm like, man. So there is a risk, obviously, with the Fed doing what it's doing, and concerted global central bank tightening into this inflationary environment. There is a risk that they really, really destroy the demand side. When we get some sort of 2008 or worse moment, that's above my pay grade to predict how bad that demand destruction event's going to be. And frankly, I don't think anyone can predict what's going to happen. But if we get anything but an absolute, major recession or even depression, something like copper in the mid to long term looks pretty hard to ignore in terms of the fundamentals right now. What happens in the short term, I don't know. We could easily go back to $2 and correlations going to one event where everything gets destroyed, which is kind of what we're seeing at the moment, right? I don't think it's been fairly orderly so far, but it's been just about every asset class participating to the downside right now. So I would be a little cautious in the short term, but I'm going to try my best to not be gun shy if and when these bargains kind of show up for us in the copper space, because I am very much a mid to long term copper bull.
Are those the two commodities, gold and copper, that you're most bullish on right now?
The supply demand side of things looks pretty bloody exciting for most metals. We typically focus on the metals space here at Sprott with a bit of energy as well. But, even stuff like the agricultural commodities, potash, things like that, I think look really, really exciting in the long term. The West seems hell-bent on self-punching itself in terms of policy on what's going on and, in the potash space. And, with, a lot of these fertilizers are very energy intensive in terms of how they're produced. And you just have to look at what's going on in Europe right now to look out and think there's going to be a shortage of this stuff, or there already is a shortage of this stuff globally, right? So the agricultural commodity space is very appealing to me. The energy space, is very appealing to me, particularly even just your old school hydrocarbon type stuff. Like it's for so long it's been a dirty space to be involved with, right? The whole ESG movement, which I sympathize with at a base level, but I do think as a global society, we've totally misjudged what this rapid transition away from the hydrocarbon space is going to mean for the average person globally. So I do think there is a place for traditional old school energy here. I'm interested in buying weakness in that space as well. The nickel space, I think, I've always gravitated towards the nickel story because I do think that remains extremely interesting. And there is, particularly on the nickel sulfide side of things, very, very few quality projects globally, very, very few. So the supply-demand dynamics there looks quite interesting. Probably be a little bit cautious in the short term. There are some projects coming online that should, provide some supply in the next couple of years. But again, when it comes to nickel sulfide projects globally, there's just the cupboards are bare. There are only a couple of projects globally that interest me. So I'm probably sounding like a raging bull in the middle of a bear market, but if you peel away the current sort of structural, liquidity-driven despair we're seeing, as long as you're not a complete sky's about to cave in on the global economy thinker, you've got to have a look at the mid to long term, and it looks pretty rosy if you can weather this current bout of of malaise across global markets.
Are there any type of mining investments like explorcos, developers that you're avoiding due to the situation? Like, for example, developers, because of the inflationary environment, many of them have been sold off to like 0.2 NAV, kind of to your point.
Or worse, yeah.
Or worse.
Yeah.
And they're not that far from production, or even like Orezone, what are they at, like 0.6 or something like that, to where
Yep.
these, the valuations are pretty low and they have high inflationary costs. Are you avoiding those, or does that make them attractive?
You know what? The answer is that it depends, right? I mean, some of my clients love risk. They'll come to me and they say, "Look, I'm okay taking a bath if it doesn't work out. This is my risk capital. I want to go after, swing for the fences and try and hit, 10 to 20 baggers, knowing, there's a risk of complete loss. This is a small, tiny bucket for me that I want to have some serious speculation with. If that's your mandate, those kind of developers are attractive right now because they've been absolutely thrown out with the bathwater. There's been no interest whatsoever. And I'm looking at companies that we quite like the asset. We think it's a decent asset, and they're off 70, 80, sometimes 90% on just 18, 24 months ago, right? If for me personally, I mean, I'm at the moment, I'm more interested in if I'm going to go down the sort of junior route, companies that have funding in place to get them through the next 12 to 18 months and ideally 24 months. Because the thing that can really get you, if you get the timing wrong, and we waddle along and down in the doldrums here for a lot longer, is, if these companies are forced to raise big slugs of equity, 80, 90% off their highs, it's very hard to come back and get back to where they were with that level of dilution, right? So, these junior equities are almost like call options with time value, right? That decays over time because they have to continually fund to do what they want to do. So for me right now, if you're a quality junior with a quality management team that was smart or lucky enough to raise a big slug of capital in the last 12 months, and you've got 18 to 24 months worth of work ahead of you where you're not going to need to raise money, that's very interesting to me right here. Now, those companies tend to have not sold off as much because the market sees there's no financing overhang. So they're not going to be quite as cheap, or there's not going to be quite as much optionality when things do turn and start ripping. But, I've been in this game long enough to know that timing these turns is very, very hard, if not impossible. So to me, the risk reward at this point favors, I'm not going to call it being conservative. There's nothing really conservative about investing in the junior mining space, but on a relative basis, the more conservative approach, investing in well-funded juniors with good projects, good management team, that is very interesting to me right now.
So when you have, those 80% drops, I've had to unload a couple of 80%, 70, 80% losses in the last 2 years, because to get back to your initial entry point is a fivefold. And if you can offset that for capital gains purposes here in the States, it makes sense to sell oftentimes. When you have clients and they're down 80%, what is that conversation? Can you give us some of the general things that you share with a client when they're down 80% on a position?
Yeah, I mean, generally I try not to get to the 80% drawdown level, but it does happen,
And Exploracos in particular, right?
Especially with Exploracos, it comes down to, do we still like the project a lot of the time, right? I mean, sometimes the best answer is to average into it, particularly if they have, I've had a couple of instances off the top of my head where they have sorted out the funding situation recently, and they do have 12 to 18 months runway. If it's applicable for the client, their risk tolerance, what they're trying to achieve in the portfolio, we might look at averaging down. If they've got some gains elsewhere in their portfolio, they need a tax loss, they're not interested, they've been beaten over the head, they're over speculating in junior mining stocks, which have had a tough couple of years, maybe we harvest the tax loss and look elsewhere, So it's kind of I hope it's not a cop-out answer, but it is a depends answer. I do have clients that come to me and this doesn't bother them at all. This doesn't faze them. They almost like this because, you only get really like full-on wiped out sentiment, beat up, everyone hates it once, maybe twice in a decade if you're lucky, right? And they can last a lot longer than you expect, these periods, but they do only come around, like this level of disdain only comes around once, maybe twice a decade if you're lucky. So if you've got the stomach for the volatility, this is what you've been waiting for, right? As long as you've got the patience to take on a bit of scar tissue while you're playing the turn.
Well, Sam, you follow the Australian markets. How do the Australian mining market, how does it compare to the North American peers right now?
For a long period of time there, the Aussie market was the darling, particularly in the gold space. I mean, the Aussie market had 6 or 7 years where it dramatically outperformed its North American counterparts for a whole host of valid reasons. They really nailed it for a while. In the gold space, the last 12 to 18 months, that has flipped. They have fairly dramatically underperformed, again, for another of somewhat legitimate reasons. There were a number of companies that decided that Canada was a lot cheaper Canada and parts of the US were a lot cheaper to buy assets than in Australia, which was true. And they came over and picked up Canadian assets or American assets. To date, those acquisitions have been slightly to moderately disappointing in terms of the execution. Now, to be fair to these companies, COVID happened right in the middle of this acquisition spree. So talking to management teams, they just weren't able to get on site with personnel for 12 to 18 months later than they anticipated. And that does impact when you're going into an asset, trying to change how they mine, the culture, all that sort of stuff. If you can't get people on site, it's very, very hard to implement that. The last 12 months, I mean, the Aussie gold space has been hit harder than the North Americans. I think to the point now where it's actually quite a big opportunity. I think a couple of the quality names there, that is particularly on the big producer end, are attractive. I guess the other big difference in Aussie right now is they really latched onto the lithium trend much, much earlier than the North American space. I mean, there have been some absolutely spectacular returns out of the lithium space in Aussie. And I'll freely admit I've mostly missed the lithium trade. I mean, there are some reasons why I'm a bit coy on lithium longer term. I do think some of the valuations are a little bit obscene at the moment.
I've had some Australian contacts tell me that over the last year, that they think it's gone a little crazy on the lithium valuations.
But I mean, you look at the lithium price, you look at some of these couple of these Aussie miners are making in terms of cash flow right now, and it is insane. To be invested from here, you have to bet that continues, into the future. And in my experience, whenever you have a commodity sector generating, 60, 70, 80%, operating margins, it just doesn't last. Supply eventually comes in and you have the opposite effect. And the problem for lithium for me has always been there is no shortage of, above ground resource reserves, known potential supply. It's just all about the capex involved to process it, get it out of the ground and get it into a usable format. And there are bottlenecks there. There are reasons why lithium is very strong. Same tailwinds of why I like copper, why I like nickel apply to lithium. Particularly the battery. It's all the battery trend. But yeah. So in a nutshell, Aussies have nailed lithium. Gold's been a bit weak, but everything else is kind of more or less similar in line with what's going on over here at the moment. I will say one difference between Aussie and Canada in terms of the junior space is we do tend to see a lot more serious, actual, green or even kind of, quality brownfields exploration going on in Australia or from Australian funded exploration companies. What we see a lot in Canada is there's just so many retreads, right? It's like there's a factory coming out of Toronto and Vancouver of assets that have been through multiple cycles. There's nothing really new to do. You go and poke a director's hole into a known or high grade part of an ore body, put out a news release, hope you're in a hot enough market and get a big re-rate. And it's like a big, it's just like a big game that everyone plays. We do feel like on average, and there's obviously plenty of exceptions on both sides, but we do feel like in general there's a much more healthy culture and mindset out of Australian-backed explorer code teams. So on the pure exploration side, on the junior end, there are more things catching our attention in Australia right now.
But you got to be on top of it in terms of the time frame, which you do for your clients, right? If you put them in an Australian Explorco, you're watching that at hours when you could otherwise be with your family.
Yeah, that's
the challenge for us in North America, right?
Yeah, my wife will say I'm always on my bloody phone. The Aussie market at the moment, the Aussie market opens at 5 p.m. Pacific time. I'm here in San Diego, so and then it closes at 11 p.m. So then I'm up at 5 in the morning to get in line for US market. So it is a bit of a drag on that sense, but I enjoy it. I love it. I do it for a living, so it's all good. And we tend to back companies, where we're not going to sell at one bad drill hole, right? It depends. If it's an absolute wild ass drill play, maybe we would, but by and large, if you're buying a discovery play where there's a couple of good holes and you're waiting to see what happens with it, you probably don't necessarily need to be on the sell trigger from a single news event, or at least with the Aussie names, we have to be a little bit like that. So.
Well, Sam, you're an investment advisor, portfolio manager. If someone likes the thoughts you shared today, how could they get in contact with you?
So probably best to just hit me up on my email. My Sprott email is S as in Sam, Broom, BROOM at SprottGlobal.com.
Excellent. Well, thank you for your insights and joining me on the show today, Sam.
Yeah, a pleasure.